Right, last story of the day. This is before the big recap. God, and the recap's massive these days. Quarterlies and announcements is bloody off its head, the ComSec register. So Yancoal. Usually don't talk about coal. Coal doesn't get talked about by anyone these days because it's such a little... goes against the grain of the whole decarbonisation thing, but it's still putting the lights on for all these cameras, and they are making cash over fists, these coal companies. Trav, give us a bit of insight into Yancoal's quarterly yesterday and the whole market.
Yeah, thanks, Matty. I mean, JD and I were looking at the screens like yesterday, and Yancoal dropped their quarterly aftermarket, and we had a look, and it certainly caught our eye. And we ended up doing a little bit of a deep dive, and this is an obscure stock, right? I mean, it's capped at $7.5 billion, which that's bigger than Sandfire, that's bigger than Evolution, and yet it's a name that most of our audience probably actually hasn't heard of before. And that in itself is strange, and I think there's a couple of reasons for that. Mostly because if you look at its share register, 3 names own about 85% of the float, and they're all Chinese names.
Wow.
One party in particular owns 62.3%. So that only really leaves 15% of the shares in free float, and that's split between the ASX and also the Shanghai Stock Exchange as well.
So, and they're giving out like a 17.5% dividend yield. So
it's massive. I think it's above 20%.
They booked in 70 cents.
Yeah.
So that 62% shareholder is getting billions in the...
It's a huge dividend yield, and I think that's part of what has caught Jonas and my eye is when you look at the dividend yield that these companies are producing. Yancoal stands out to me mostly because of its trading valuation. Though, if you look at this company on an EV to EBITDA basis, and we've talked about EV to EBITDA before, Matty, this is just the multiple that you can use to benchmark other companies. What multiple of their earnings do they trade at, right? And
so it's the popularity measure on the stock market in a simple way, is it, Trav? Or how would you dumb it down for us?
I wouldn't call it popularity. I mean, there's good reasons why some companies trade at certain multiples, and even why some sectors trade at higher multiples. For example, in tech, you get really, really high multiples because the earnings is deemed to be super sticky if it's subscription revenue. In mining, it's a much lower multiple because that revenue is not forever. There's a mine life associated with it. So.
And I think a lot of investors feel it goes one step further than just looking at a PE, which would be the share price over the profit of the company. It just goes one step sort of further into the actual operating cash flow of the company and really separates that out for shareholders and not incorporating the debt holders within the company.
Yeah, totally. Exactly right.
Thanks, lads.
So what I did this morning is I charted up how does Yancoal and also the other major coal producers on the ASX, like what sort of multiple do they trade at, and compare it to some battery metals names. And I've also chucked BHP in that chart as well. Viewers on YouTube will be able to see this. And Yancoal trades at 0.9 times its forward-looking next 12-month EBITDA, and that is genuinely crazy to me. I just rarely ever see a company trade at 0.9 times forward-looking EBITDA. And the highest one there is New Hope in the coal section at 2.3. So there's still very, very de minimis multiples. But the really surprising thing there is these companies are printing cash at the moment, like absolutely just printing cash.
So just to hit that point home, the share price of the company more or less equates to 1 year of earnings of the company.
Wow. Literally.
Pretty astounding.
So it was...
Even by coal standards, that's
Capricorn
astounding.
was trading at 9.
It was about 11, yeah.
11.
Yeah.
So they're at the other end of the
spectrum.
But looking at this business, if this was a gold mining company, they would most likely be trading at 11.
No, if it was a gold mining company, it would be between 3 and 5.
Okay.
Yeah.
Remember, Capricorn trades at a premium to peers because of what we've previously discussed with the quality of management.
Yeah,
totally.
Okay. Yeah.
I've put 3, so 3 battery metals companies there, Lynas, Sandfire and IGO. They trade between 6 and 12 times. So I mean, we're talking just genuinely just a crazy difference in multiples. In some cases, they're an order of magnitude difference.
And for people just listening to the podcast, you can see the other coal names. They're trading at about 2.3, 1.9, 1.1. So the rest of the peers, like Trav said, all around that 5 up to 12 times multiple.
Exactly. And I think at some stage we should really unpack, what has caused the derating in these coal companies. And I mean, we can, in a nutshell, I think there's 3 reasons. The first is, there's an enormous amount of institutional investors are actually mandated to not own any of them. And then, secondly, a lot of banks are mandated not to be able to debt finance these companies. So the cost of capital goes massively up when that happens. And then thirdly, the consensus outlook on the longevity of coal is in doubt versus the materials that are touted to be really important for the energy transition. I think, then I still look at that 0.9 times EBITDA and think the energy transition is going to happen over a long period of time. Just the 0.9 times EBITDA is really astounding to me. So I just really wanted to dig into that and what's really going on here. Like if you take that coal factor away, like why is this company still trading at such a massive discount? And I think there are 2 big reasons why. Firstly is that all companies that have a majority, especially Chinese ownership, or even just a majority ownership from a single entity, they will typically trade at a discount because there's just uncertainty with how the dynamics will play out from a concentrated share registry. So there's that element. And the second one is I don't actually think that investors have full confidence that they'll be the beneficiaries of the cash buildup that's happening at this company. And like, what do I mean by that? Well, if you're a company and you're getting this huge amount of cash in the door, there's basically, as I see it, 5 things you can do with that cash to actually be using it efficiently. The first one you can be doing is investing in your own growth projects. And in Yancoal's case, their growth projects are pretty de minimis. They don't need a huge amount of capex in order to execute them. So like put a line through that. The second one is M&A. So you can have this inorganic growth. You spend the cash in the door on acquiring other projects. In Yancoal's case, because their share ownership is of these Chinese entities, they'd actually require FIRB approval for any M&A that they were to do. And FIRB has had a complex history of approving things historically. So there'd really be no certainty that FIRB approval would be able to be achieved if they were to do that. So that one's in question to me. The third thing they could do is pay down their debt, and they've actually done that now. All of their debt's paid down. They've got no interest-bearing liabilities anymore. The fourth thing they could do is buy back shares. And when I tuned into their earnings webcast today, management said that buybacks were not on the agenda because their current thinking is that they need to improve liquidity on all their exchanges. So keep in mind, only 15% of this company is free float. Back. Yeah, exactly. So it's a challenging, they want to improve liquidity. They see that as the objective, so they're not going to buy back the stock. And the fifth one is dividends. And the dividend policy of this company is to pay the maximum of 50% of their free cash flow after tax or 50% of their net profit after tax, whichever one is higher. So that's 50% to dividends. That's still a lot of cash that you're wondering, how are they going to allocate that efficiently? And so I think what you're seeing there is this company is really cheap purely because the investors just are skeptical that they'll be the real beneficiaries of the cash buildup that this company is going to endure over time. And if I was a shareholder, I'd be really hoping that this company announced the change in its dividend policy or plan to buy back, and that would be a catalyst for a big re-rate, I suspect.
Yeah, I think the buybacks is a real kicker. There are investors out there who still buy coal stocks, and the sort of philosophy they take on how they're going to see a return on that investment is no longer like any other value stock you'd see out there. They're not thinking the market will cotton on sooner or later and that the share price will appreciate. They take the stance that the company will buy back so much of its own stock that the share price will sort of go about increasing that way, and that, sooner or later the company may not even be a public company anymore. But they're not really relying on that traditional appreciation in the share price.
Would that have to be one of the most illiquid stocks that is up around $7 billion market cap? The fact that there's only 15% of shares of the company available for trade to retail?
I can't think of a comparison. I imagine there are other examples on other exchanges, but to my knowledge on the ASX, that'd be up there. Keep in mind though, it would still be quite liquid because 15% of $7 billion is still a lot of stock.
Yeah. Yeah. All right, good on you, lads. Great insight. Great little research. And tell you what, now that we're flowing on and we're into episode 12, I feel now, here's a bit of positive feedback. I feel that your research is taken to it's gone to a new level.
I'm bringing out the Excel charts, Matty. I'm getting back on the tools and liking it.
It's very, very well done, lads. Thanks for making me look extremely good. I appreciate it.